The financial world is in constant motion. What's profitable today could easily become a liability tomorrow. Just like how weather patterns shift, so do the dynamics of global economies, and that directly impacts your investments. For instance, not too long ago, many viewed Australian government bonds as a prime opportunity. They offered solid returns and stability. But today, that landscape has changed, and those once great returns have slipped away. This is the reality of the market. It's fluid, always adapting to new forces. The investments that appear to be winners now can quickly become losers as economic conditions fluctuate. This makes the advice of yesterday increasingly irrelevant in today's world. What you thought was a safe bet might no longer hold up, and that's where the importance of adaptability comes in. This brings us to a concept that should guide every investor's strategy: the instant exit strategy. The instant exit strategy is built around one key principle: liquidity. To put it simply, liquidity is the ability to access your funds swiftly and with minimal friction. The goal is to ensure that if an investment starts to go south, you can snap your fingers and be out of it in an instant. If you're unable to exit a position quickly, whether due to market shifts, deteriorating performance, or an unforeseen event, you risk exposing your principal to unnecessary danger. The snap metaphor refers to how quickly you can move from being invested to holding cash again. This process should be seamless and fast, ideally taking no longer than a day. The market is unpredictable, and you never know when it might turn against you. Being able to liquidate at a moment's notice can mean the difference between preserving your wealth and watching it erode. Why is this so important? Because without liquidity, your investments can get stuck in positions that no longer align with your goals or the market's reality. When you invest, you're not just looking to grow your wealth in the long term. You're aiming to generate a regular income stream. If you tie up your capital in something that can't be liquidated easily, you're exposing yourself to unnecessary risk. Consider the 2008 real estate crash. Everyone thought they were sitting on solid investments, from everyday workers to large-scale developers. But when the market began to collapse, people found themselves unable to sell their properties quickly enough. As liquidity evaporated, the damage was done. Many investors who could have gotten out in time saw their net worths wiped out, all because they couldn't access their money fast enough. Had those real estate investors followed the instant exit strategy, they could have seen the warning signs and exited their positions before the market spiraled. The truth is, in the world of investing, you need to be ready to adapt in real time. If you can't quickly pull your money out when things go wrong, your principal is in jeopardy. A prime example of the instant exit strategy in action comes from an experience with a favorite dividend stock, Southern Company. The stock price surged from $43 to $53 in just a few months, netting me a substantial unrealized gain. I could have waited for the stock to appreciate further, but instead, I took advantage of the price spike and cashed out. By selling quickly, I locked in years of potential dividends in a matter of months. Sure enough, within a few weeks, the price retreated. But because I followed the instant exit strategy, I had already pocketed the profits. When the price dipped, I was able to buy back in at a lower price, ready to ride the next wave of appreciation. It's a strategy of seizing opportunities when they're hot and being ready to act fast when they cool off. This same principle applied when I anticipated rising interest rates in 2015. Instead of holding onto my bonds and risking the inevitable drop in value, I preemptively sold off my holdings. I didn't wait to test the market or hope for a reversal. I got out before the decline could affect me. While the timing wasn't perfect, I felt more comfortable holding cash than risking substantial losses. Key takeaway: the instant exit strategy is about being proactive, not reactive. If an investment isn't easily liquidated, it poses a threat to your capital. Quick exits allow you to protect your principal from unpredictable market shifts. When the market changes, you need to be able to pivot fast to avoid being stuck in a losing position. Conclusion: the market is fluid, and the best defense you have is liquidity. If you follow the instant exit strategy, you'll always have the option to move your money out of a risky investment before it turns into a major loss. In today's ever-changing financial environment, having the ability to act swiftly is not just a luxury, it's a necessity.